Thank you very much, Matthew. Well, remember those huge private equity deals that juiced prices up by loading companies up with their debt? Well, the firms that bought them are finding they've got to eat their own cooking. I'm here now with Scott Victor. He's a founding partner at SSG Capital Advisors, a special situations investment bank. Scott, great to have you here on Street Smart.
Great to be here. Thanks.
Let's talk about, during the boom, you had hedge funds. They were the lenders for the private equity deals, correct?
Many times, asset-based lenders, and when you got more sophisticated financing, the hedge funds came in to lend on some of these private equity deals, yes.
Are we seeing changes in that?
No, the hedge funds are still active. The market today is obviously better than it was a year ago this time,
right.
And the hedge funds are actively looking for investments in today's market, as are the private equity funds.
But some of those private equity funds, I mean, they're struggling with their portfolios at this point, safe to say.
Well, they struggled greatly.
They're smiling a little bit.
They are mostly through their struggles. They struggled greatly the last 18 months. Roger Kraus, the co-CEO of Sun Capital, was here today in Palm Beach and addressed this audience at the M&A Advisor Conference. And he went through his portfolio and he had good graphs, and he showed that the worst of the downturn was in the first quarter 2009, when the greatest fear happened at the end of 2008.
Right.
And they showed remarkable turnaround in their portfolio performance the last 2 quarters. And I think a lot of the private equity firms are seeing that the bottom has passed us and there's starting to be an uptick. Those private equity firms that had portfolio companies that were in trouble, they really looked hard.
Right.
They did triage. They did what they could do to reduce their expenses, and now they're reaping the benefits of that as the top line revenue grows to where it was.
You make it sound rosy. I mean, are you saying that there aren't those private equity firms that are still kind of struggling with those companies that can't make a profit? I mean, there are still those situations.
There are still those situations, a lot in retail, a lot in other industries that have not had a recovery yet, as they've had with some of the other industries. And those industries that are still in distress today in the macroeconomic environment, those portfolio companies are still struggling with too much debt.
And it's going to be that way for some time.
For some time.
Right, right. Let me ask you about, what about swapping debt, though, for equity? I mean, how does that kind of change their investing horizons?
Well, that's been really the most prevalent change in the marketplace, literally in the past 6 or 7 months, I would say. A lot of transactions, some that we're involved in, where the hedge funds and CLOs that were the lenders to companies, be they private equity portfolio companies or otherwise, they saw the bottom of the market and there was no good sale alternative for these troubled companies that they were the lenders in. So they, the hedge funds, have the flexibility to convert debt to equity and do prearranged or prepackaged plans. And there's been a great prevalence of that the last 6 months.
It's interesting, but it's a very significant and new trend, isn't it?
It's a new trend because it's the best alternative for a distressed situation when you can't find a buyer at a proper value in the marketplace, for the lenders to take over in a prearranged or prepackaged plan.
I mean, it's a necessary trend at this point.
It's a necessary trend to preserve value for those lenders who otherwise would take a loss if the company were sold on the open marketplace.
But ultimately, they've got to think about their investors, those private equity investors, and getting returns for them. So ultimately, there's going to be some kind of changes down the road.
Well,
or they hope, at least.
Yeah, when there's a conversion from debt to equity, the ultimate goal is to wait for a rosier day when the market is better, and then to sell out of those companies that they've taken equity control of when the economy's better.
When do you think that it's going to be better? I mean, let's take kind of the bigger picture, the macro picture, if we will, because we've had some debate here in today's conference.
Okay. I think that the economy is certainly a lot better than it was. The capital markets, which we play in every day, are better than they were even 6 months ago. More deals are getting done today at, I won't say at heady multiples or heady valuations, but certainly better than it was 6 months or 12 months ago. So the capital markets have thought a bit, and more deals are going to get done. And as the capital markets thaw, if someone can figure out how to get people back to work so that the employment rate goes up, then that will improve the general economy.
But we've got 30 seconds left here, Scott, but that's problematic because nobody really talks about that unemployment rate coming down anytime soon, at least, and not coming down significantly anytime soon.
That's a problem. There could be a prolonged high unemployment rate, which would otherwise dampen a pretty robust market for the end of 2010 and going into 2011.
So that's the kind of key metric to watch at this point in your view?
No, I wouldn't say employment is the key metric. I think the capital markets continuing to open and to get deals done, that's the critical metric for the distressed market today.
All right, so keep an eye on that. That makes sense. Scott, thank you so much. Appreciate it.
Thank you.
Scott Victor, founding partner of SSG Capital Markets. That's a special situations investment bank.